Yeah.
Okay, I'm Todd Johnson. This is Marcia, and she is Schwarzkopf, and today we're going to talk about lending.
Awesome.
Here we go. So, let's see, what are we going to do today? We're going to talk about a number of things: financing options, types of lenders. We're going to give you some financial facts. We're going to have some tips. We're going to talk a little bit about derogatory credit, or really Marcia is going to. How the loan process works. You know, responsibilities between buyers and realtors and expectations, the role that we play as a lender, do's and don'ts, you know, how do you choose a lender, and a number of other aspects. So there are a number of financing options, and we're going to go through each of these in detail. So there's 100% financing options, and as you can see up there with the USDA, FHA has one, and VA. We're going to talk a little bit about conventional financing and combination loans, as well as the jumbo market, and we'll talk some about construction loans. Is there any topic you guys want us to hit on that you have a question on? Complete, you know, whatever. It could be anything to do with lending, something that you're confused with, something that you question, maybe something you've heard from one lender to another lender that maybe doesn't make sense. Anything like that? Go ahead.
First-time home buyers with disadvantaged credit.
With the which one?
Disadvantaged credit, so first-time home buyers with low credit scores.
Oh, yeah, we're going to talk about that for sure.
Okay.
We're going to do that. We're going to hit that topipic.
Can you talk a little bit about the Cash Advantage program, the cash rate program that's provided by the Oregon Bond Program, and then also talk a little bit about the HUD program that is out there for first-time buyers to sort of do their savings program, and HUD will match the amount. Do you have that?
Yeah, we're familiar with that program as well. And there's a couple programs, and again, there's a program that allows you to get into that and hold, save, and they'll match X amount, and we've done that with the community projects as well. There are programs out there that would negate that, the need for that. So why make a consumer go through the challenges associated with saving up the money if we can immediately put them into a 100% program right now?
Okay, well, then you're going to talk about those kinds of
We are. We'll talk about those. And
203K.
Mm-hmm. 203K.
203K.
sure, yeah, we can talk about that, and the construction rehab loan, absolutely, and not a problem. And again, anything as we go along, we're going to ask questions, and I'll have some, like I said, trivia, and we'll give a $10 Starbucks card for correct answers. I'll have you guys raise your hand, and then we'll call on you. Go ahead.
I was going to come up with an answer already.
Oh, you already. So this is
Want to go to Starbucks?
You have a question
The answer
first,
to
right?
that is, you know how they do
Jeopardy.
How they do it.
Yes.
Who is
What is,
Yeah.
who can embarrass themselves the most?
or Family Feud when they come out. I like Family
They
Feud.
hit the button before it's time.
So, and Marcia obviously will jump in as well and help. So the USDA program is a great program for providing 100% financing for buyers. It's it has to do with properties that are in rural areas. And believe it or not, there's areas of Wilsonville that are considered rural. You guys are out in Clackamas, so areas out at Boring, Sandy, Damascus, all of those. Now, who knows the only challenging side? What's the biggest challenging side on the lending side with USDA? Does anybody know that? Go to Google. You can Google USDA. He wants me?
He said when you're done. You forgot you were doing the class this morning.
Okay. I think I have another meeting with him or something. But you can check on this website and know if your property's eligible or not. Did I hit the wrong button? There we go. So it's only for primary residence. It does have credit score limitations, so you have to have at least a 640. You can do up to a 6% seller contribution. So you most likely wouldn't need it, but if you think about it, if you were buying a $300,000 home, you could have up to $18,000 in seller credits if you could work that in. And sometimes we maximize the credits if the house is going to appraise and the seller is going to be accommodating, because you can end up buying the rate down as well, so we can play with the numbers to make debt-to-income ratios work and maximize their purchase price. They do have a upfront MI fee, if you will, financing fee, and it's 1%, and the monthly MI factor on a USDA loan is very low. It's only 0.35. Where on a FHA loan, we're going to talk about it, is 0.85. So it's a 0.5% better, which can be significant. The rates follow FHAs, so the FHA loans, VA loans, and USDA loans all kind of follow the same rate pattern. There's not one that's really better than the other. They're all about the same, and they're all very low. Anything else you wanted to add about USDA?
Just that they look at, did you talk about how they look at total household income? There's 2 income criteria, income to qualify with, and then total household income
Right.
can't exceed.
Go ahead. I didn't talk about that. I forgot about the total
Okay.
household.
So when we qualify a borrower for USDA, there's 2 income components. The first one is, do they qualify off of their salary for the loan? The second one is USDA requires us to look at total household income. So if you have a husband and wife and the applicant's in the husband's name only, and say he makes 80 grand a year, so he would qualify for it. But the second component is USDA looks at joint family household income. So if the wife made 80 grand a year, even though she wasn't on the loan, they wouldn't qualify for USDA because they look at the tax returns and they look at joint household income.
What's the max?
It's about 90, for a 2-person family, it's about 88 to 90.
Yeah, 88,360 or something. Don't quote me exactly on that. We'd have to
We
look them
can
up.
send that to you.
But it changes based on family size, and
Yeah, and so if they have a child, even though the child's not on the application, that gets counted toward family household income limit. So it would increase it from a 2-person family to a 3-person family. So there's a few different components that we have to run when you're looking at USDA.
Can you tell me what that 6% seller contribution means?
so it doesn't. It just means you can allow up to a 6% seller contribution. Yesterday you weren't there yesterday. Yeah, you were. Yesterday in your meeting, or was that a
Yeah, it was
Wednesday?
Wednesday. That was
Wednesday.
Wednesday.
We did a meeting
I
and we
was
talked
here.
a little bit about seller contributions versus lender contributions versus no contribution. Meaning, if you are getting ready to put an offer in on a house, a seller, you can ask a seller to cover closing costs, correct? So a closing costs and or prepaids. So closing costs would be things like title fees, appraisal, any lender fees, recording fees. Those types of things are closing costs. The prepaids would be your interim interest, your homeowner's insurance, and property taxes. So up to 6% of the sales price of a home, a seller can contribute towards those costs. Can't exceed that amount. That doesn't mean they're going to, and it doesn't mean you're going to ask for it. But as we did a little example in the Amber Glen class on Wednesday, it makes more sense, usually 9 times out of 10 or even higher, that you ask the seller to contribute towards closing costs versus a lender cover closing costs. Now, who knows how does a lender cover closing costs?
Increasing the rate
And what does that do?
increases your payments.
Makes the payment a little higher, but how does increasing the rate create a credit?
It gives them future money that they can use to put on that credit line and cover it now. So they put out the money now, knowing they're going to get it back later with their increased loan payments.
Yes, so increasing an interest rate creates what's called a yield spread premium, and in doing so, a lender can cover those costs. So I'll give you a card for answering that question.
Oh, thank you.
So now, what would be better if you have a $300,000 loan and I make the interest rate 4 7/8 as a lender and we contribute towards their closing costs and prepaids? Or if the loan amount was just slightly higher because we adjusted the purchase price, but the interest rate's now 4 1/4. Do you see how if you have 4 1/4 on basically the same loan size versus 4 7/8, and the lender providing the credit versus the seller, the only downside would be is if the property wouldn't appraise. But in general, having a lender, when a lender says, oh, we're going to provide a credit, it's kind of a red flag because your buyer is now going to have an increased rate. There's no other way to do it. Money just doesn't get created out of thin air. But it's and I won't say always, but I'm going to tell you, generally I haven't ran into a situation in my 27 years that adjusting the price a little bit and having a seller contribute will be the better way to do it. So the FHA, the Federal Housing Administration, people always think, you know, when they hear FHA, they think first-time home buyers because F&H, you know, first-time home, but it's really just the Federal Housing Administration type loan. It's a loan that we use very often. It allows for minimal down payment, 3.5%. There is an upfront mortgage insurance, and when we say that, these are all financed in amounts. So we're not a lender that's doing anything different than any other lender. This is the way the program works. It requires the 1.75, and that creates what's called your total loan amount. Your base loan amount would just be your 3.5% down of the purchase price. The monthly mortgage insurance ranges, but it's 0.85 in general with the 3.5% down. If more down payment is provided, the monthly mortgage insurance premium does drop, as well as if the loan term drops, the monthly mortgage insurance premium can drop. But trying to keep this simple. There are no income limits, as there are in USDA, so anybody will qualify. You don't have to be a first-time home buyer. You can use an FHA loan over and over. You can't have two FHA loans at the same time. Is there maybe a caveat to that if you moved out of the area? Could you?
Yeah, if you were moved for business purposes, like relocated, then you could have an FHA loan on a house in Texas and have one here.
But it have to be a make sense and to do it.
What I don't like about it is you have insurance for the life of the loan.
Didn't used to be that way, but that's a very good
Now
point.
it is.
Yeah, so, and you're right, the idea that you're going to have mortgage insurance for the life of the loan, most people using an FHA loan are coming out of a circumstance where they had a bankruptcy. So 2 years maybe into the bankruptcy or past the bankruptcy discharge, they're going to qualify for FHA financing. So it's going to allow them to take advantage of the benefits of home ownership, with the idea that they're going to get out of that loan probably in the next couple years anyway. Through increased equity, they're going to refinance, or they're going to end up selling it and moving on maybe to a conventional financing. But as far as having an MI and having it be for the life of the loan, never let that deter your buyer, because most of this is usually a first-time home buyer. First-time home buyers typically aren't going to keep the loan for 30 years. Again, I've never known anybody that's kept a loan from full term. They're always going to refinance or do something, or maybe they're going to move, refinance it into a conventional loan, keep it as an investment property. But don't let that be a deterrent. And it didn't used to be that way, but it did change. But you're right, absolutely. There are minimum credit scores, and so it's nice that we say that you can go down to 580 for a FHA loan. The reality of it is, on our AUS systems, the automated underwriting systems, which we'll talk about, you do need to get an approved eligible. And that's the caveat, and that's what's the little tricky part. So when you start getting in lower credit scores, that's where Marcia comes into play, and she's going to talk about that as well. Again, you can go up to a 6% seller credit, very same as the USDA.
So when you're asking, a loan broker, okay, I need to get this person pre-qualified. They may qualify for a USDA, but that amount will be different than the FHA. So I need to ask them, give me what they qualify on a USDA and give me what they qualify on an FHA.
Well, we should talk about the term broker and banker, correspondent lender. If you're dealing with a broker, they're going to place a loan with a lender. So they're going to have really limited control. They're not going to underwrite the file or do anything. They're going to go to lender X and they're going to order everything through that lender. And that lender is really going to dictate to them how that file moves forward. But if you're dealing with a competent loan officer, mortgage person, they should immediately be able to take your buyer and run through the scenarios that are going to give them the greatest advantage and the least out of pocket while maximizing tax benefits. You shouldn't have to. You're not going to give Marcia and I a possible buyer and they're interested in the USDA. We would give you what they would qualify there, but we're immediately going to run other scenarios and talk to them about it and say, or you can do it this way, still have zero out of pocket, but you're going to qualify for a higher amount. Payment may be a little higher, but that makes sense if you're qualifying for a higher amount. So the other thing about being pre-approved, and I don't know if the slide's on here or not, versus pre-qual, who can tell the difference between a pre-qual? Who knows the difference between being pre-approved or being pre-qualified.
Well, pre-qualified, isn't it? Oops, I was raising
Go
my
ahead.
hand.
No,
but-
go ahead.
Go ahead.
But pre-qualified, doesn't that just mean you're just trying to find out, what they can actually go out and search for a house on? That's just sort of a preliminary number, but when you pre-approve, you actually have a tie with the lender that says, I'll give you this amount. This
So-
rate.
If you're dealing with a broker, that's probably it, but even in most cases, brokers would want to get them pre-approved. You as a realtor, you want your buyers pre-approved. You don't want them pre-qualified. Makes no sense to pre-qualify somebody because there's ambiguity, because what are all buyers?
Liars.
That's right. And I'm not giving him a card because he knows that one. So, in general, we're not making a negative comment towards buyers. Buyers just they don't know. Buyers come into Marcia and I all the time. I make $120,000 a year. I own my own company. I make $120,000 a year. Well, their tax returns, gross sales show $120,000, but their net might show a minus 12. So they're losing $1,000 a month. They're not making $120,000. But when you have the tools, and most brokers all have the tools with the automated underwriting system, if you can get their credit and you can verify their pay stub and you can verify their assets, whether it's coming from gifts, so you got to take their word from it, or if they can show you their banking statements, you can run automated underwriting systems, whether you run LPDU or GUS as you saw on USDA, and you're going to get a full case number with a commitment. Meaning, as long as you've told the truth here, all we need to do is get these items and you get a pre-approval. So most of the pre-approvals Marcia and I will be based on, we have a full LP or DU pre-approval with this case number.
Huh, so I don't get why we're sort of taught to go down the route of pre-qualification.
Most,
We might as well just go right to the.
That's what I do.
Pre-approval.
Exactly.
yeah, there's no question.
Yeah.
And it's because it's old school, and a lot of people in the old days talked about just getting pre-qualified. And since the rules have changed, Dodd-Frank's been implemented, there isn't necessarily, and we'll talk about a little bit of the other programs that are available on non-qualified mortgages, but I think it's more semantics. Some people think pre-qual really means pre-approval, and it doesn't. People can log on to a system on the U.S. Bank or Bank of America, and I'm picking big FDIC banks, and just type in, what's your income? What's your credit score? And it's me as the consumer, them, answering these questions, and it will say, based on the information you just provided, we can provide a pre-qual of this. Tyler's received those from buyers. They came and go, here, I'm pre-qualified with Bank of America, but it's all total bullshit. Again, if it goes back to a buyer being a liar, it's whatever information was put in is going to dictate whether they're pre-approved or not. So
Can I ask one more question?
you can ask as many as you want.
Okay, so you just brought up something that I find very interesting. It's like I have a son who has a business in Sandy. He started it two and a half years ago, but when he tried to go out and get a pre-approval, he is socking money away in that business. And so he's coming out even every year because that's what he wants to do. He feeds money back into his business instead of taking it as an income. And then, of course, he works a full-time job. Well, when he was set up to get pre-approved, they dinged him for that because on his tax returns,
Not showing income.
he's out of balance. He's not making money, and he doesn't. He's sort of he's following the Dave Ramsey sort of approach. I don't know if you're familiar with that.
Sure.
Where he hasn't got a loan on the business, so he's just funneling the money right back into the business and growing it.
Well, and it really depends on how the business is structured. So whether he's an LLC, whether he's an S Corp, whether he's a C Corp, whether he's a sole proprietor. But you are right. If you have X amount of gross income and X amount of dollars of loss, and your net effect at the end of the year is zero, then he's not going to show any money. Mm-hmm. The idea is all businesses want to become profitable. So at a certain point, you want to be able to make your wages, and the way that a typical business owner will offset income is through depreciable assets. Mm-hmm. The same as we as consumers or investors, if you buy real estate that you're renting and you create a gross cash flow of X that creates a net effect of a positive, then right below that, if you know on your Schedule E's you have depreciation, which then wipes out your net gain. But as lenders, we can add back in the depreciation to create income. So what kind of business is your son's?
He owns a card shop business,
A what?
a card shop for Magic. I don't know if you've heard of it. It's a next generation sort of thing.
Tyler? Tell us what that is.
I don't know. I'm not
Magic
sure. I don't.
Collectible, it's a game card, but they're kind of collectibles, but people use them to actually play games.
They have
and-
tournaments and things like that.
It's like Dungeons and Dragons,
Oh.
kind of, but it's all with
It's like
cards.
that. It's at Clackamas Town Center. They have a place where people come in and they try out different video games and stuff. So it's a combination of that too. So it's
Sounds unique.
Well, and so does he have equipment?
Real niche.
he's gradually been, he buys it as it.
And so he may have a
Yeah.
depreciation schedule that the lender's not taking into account. And you can take a guy like that too, though, and combine him with a non-occupying co-borrower and qualify him. If he's just not showing enough income, he can qualify, but somebody might need to co-sign for him. But you're right, that's a challenge of self-employed people that, just like you guys, your intent would be to make as much money as possible and to minimize your liability to Uncle Sam, right? So 50% of your gross income goes to Uncle Sam. So the only way that you guys can eliminate that is through items such as capitalized goods. If you buy a car, you can do some depreciation. You can take mileage deduction. There's things, depending on which way you go with those types of assets. If you buy equipment, that becomes a direct expense to your business, or you can accelerate depreciation. You need a really good CPA that will help you. Tim Horst has a guy come into the office every once in a while, and he has been a CPA for 40 years, and he just specializes in realtors. He's a great guy. I have his contact information, so after the class here, I can give that to you if you want. But he would be a great guy for all of you guys to talk to, because your intent would be make as much money as we can, keep as much as you can and minimize your liability.
And then, that would be a great SUMA University class. I don't know if you guys.
We have the class out in Bethany too, but yeah.
Yeah, that teaches what's the difference between S corp, all the different, what's the best one, what's the pros and cons, that kind of stuff.
He would tell you, this CPA would tell you there's no reason for you guys to be incorporated or an S corp. He would tell you that being a sole proprietor is fine, although there are some arguments against liability purposes for being incorporated and being able to kind of shield yourself from liability.
Swing into rental properties.
I was
Yeah.
told by my CPA that when I created my when I created an LLC and then eventually make that into an S corp.
Yes, I'm an S corp,
For
but he's an
realtors.
LC, my son is.
An LLC?
LLC.
LLC, limited
It's a lot
liability.
simpler when you're just getting started in the LLCs. But yeah, if you guys haven't started an LLC up or anything like that, do that as soon as possible. It's very important.
Well, and probably the time to do it would be starting your new tax year in 2018.
Yeah.
Right.
There would be no reason to start it now because it just complicates your tax returns.
Yep, set up an account with the Umpqua or something and create an LLC as well. So with that.
The 100% program is a fund called the Chenoa Fund. It's actually an Indian tribe, and they help provide a grant. The 3.5% becomes a grant to a buyer, but it enables an FHA loan to become 100% finance. So if you ask a seller to contribute X towards closing costs and prepaids, and we combine that with this Chenoa grant fund, we can make a buyer qualify with zero money out of pocket. We literally, Marcia and I, just this last month, 3 weeks ago, closed on a young man and his wife. He just turned 21 last month. His wife is 20. They had a baby when they were in high school at 17. He's making $27 an hour and got a great job, is working hard. He had been with another lender for 3 months and they couldn't do anything with him. And he had 17 months of work experience, and typically you need 24. However, our argument with our senior underwriter was he had an education. Even though he got his GED, it was educational qualified. It doesn't say you have to have college transcripts, it just says education. We used the Chenoa Fund and covered closing costs and prepaids, and we got this young man and his wife and kid in a, what was the purchase price, $329 or something?
Yeah.
Timber.
Wasn't that your, it was
That was Brody's.
Yeah, it was Brody's.
Yeah.
And got them approved. So you can really do some great things with limited assets and not
21
having
years old.
Huh?
21 years old.
And they weren't using his wife's income because she took care of the mom, so she's paid by the state of Oregon as a long-term caregiver. But because she had to go through the state of Oregon to get certified, our underwriting said, well, if she's a certified caregiver through the state of Oregon, provide the certification. And she'd only been doing it 13 months, and they allowed the income on her side too. Even though technically we didn't need it, it just sweetened the debt-to-income ratio. But the Chenoa is a great program, and the nice thing about it is there's really two types, and one's what's called a soft and forgivable second, and the other one's repayable. I'm going to see explain those two because you didn't go into detail on these.
So if their income is less than 115% of median income, and they make 36 consecutive monthly payments on time, that soft second, the 3.5% down is forgiven. So let's say that they make 6 payments on time and then they miss one, they're 30 days late, that 36-month clock can start over again for them. So basically they want to be in the loan for 3 years and then it's forgiven.
And they don't have a second payment, they only have one payment. It's just at a slightly higher interest rate, and that's how the grant program works. I mean, it's essentially a elevated FHA loan where the grant program is obtaining their money through the yield that's created from a higher interest rate. And if they've done calculations, if they do it for 3 years, then it's paid back. If the people have greater than the median income limitation, it does become a repayable second. You want to talk about that?
Sure. So if their income is above 115%, it is repayable. No interest accrues with the 10-year amortization on the second, but it does require monthly payments amortized over a 30-year period.
There's two choices though. One is zero interest amortized for 10 years for the lump sum. So if the grant was $10,500, it's $10,500 divided by the 10 years and whatever it is per month, and that's the payment. Otherwise, you can go to a 30-year term on it if you wanted at a 5% amortization. So just to give you an example, on a $300,000 house, the $10,500 at the 5% is only a monthly payment addition of $59. So for people to not have to come to closing that they're over the income limit and they need the grant program, it only adds $60 essentially to their monthly payment, with the majority of it being tax deductible anyways.
How
So
much money is in this program in a year?
there's hundreds of millions is our understanding, and there's not that many people that are approved to do the program.
Oh, so
Yeah.
it just keeps growing then?
Well, and it's an Indian tribe, and Marcia and I do quite a few of them, but it is a great program when you have people that are saying, well, I'm going to save up. I'm going to save up.
Or I'm going to wait for my tax
So
refund.
a lot of people have been talking about, oh, you can buy a house with 0% down. Is this what they're talking about?
Yeah, yeah,
It's the Chenoa fund.
Mhm.
Okay.
yeah.
You'll see on Facebook, people are publishing, you give us 1% and we'll match the other 2. Say, well, how about you give us nothing and we get you qualified now?
Yeah, but you still have to have income to qualify for it.
Well, and they do on the other program as well. So there's nothing going to get you out of not having any income to qualify. Although we do have what are called non-qualified mortgages, where you can do an asset based. So it's called an asset depletion model. So if you have a self-employed person that has a tremendous amount of assets, and they have the down payment, but their tax returns show 0, like your son, but maybe not in that situation, somebody maybe that's older and established, still playing the game and not showing income, we can take their asset base, use a calculation called an asset depletion model, and create their monthly income and qualify them. So those programs do exist, they're just a little bit outside the box.
Yeah, and there's also that bank statement that if a self-employed borrower we can analyze 12 months bank statements and use a percentage of their deposits, and that can be used for income in lieu of tax returns.
Oh, really?
And I know we got another slide coming up to talk about this, but I'll ask you anyway, since we're talking about down payment. You're gonna hear from a lot of buyers, I'm just not ready yet, I wanna save up.
Yeah.
I wanna save my money down, I need money down. Okay, so I'm gonna do a hand raise. So, because you're gonna yell out stuff, Tyler, you're out. For every $1,000 somebody saves for down payment, how much does that in today's market save them a month in a monthly payment? Every $1,000 they save to put down on a house, how much does that reduce their monthly payment by?
$10.
Gotta raise your hand.
Oh.
You said how much?
$10.
Okay, Dave,
5.
5?
6.
5,
I'll say 8.
8.
15.
7.
Okay. So give me an interest rate. What do you think that it is today?
3.75. Well, that's probably too cheap.
4.4.
How about 4?
4%.
Sure.
Okay. 4%. So at 4%,
This is for down payment.
this is just what. How much does it save you
$1,000.
at on $1,000? Get your HP. I think my battery's going dead. $4.77.
Wow.
We were close.
So the first $5 gets the answer right there.
Dude right there.
There you go.
That's on your monthly payment.
So if you think about that, and you have this information in your repertoire of communication skills with your buyers. Don't let the objection of I have to save money deter you from pushing it forward, because you can always ask them that. Say, really? Say, help me understand that if you think, how much are you trying to save? Well, I want to save $10,000. How long do you think that's going to take you? Well, I'm going to have that probably within the next 12 months. Well, if you could buy a house right now and you didn't have to save it, and you'd still qualify, and you'd still have a low interest rate, would that be better? I want my payment to be as low as possible. You can just ask the same question. How much do you think saving $10,000 over the next year is going to save you per month? And we already have the answer, right? $47.70. And they go, what? Really? That's it? So realtors that are empowered by having this knowledge are going to be much more, you're going to put more deals together. Realtors that get those kind of buyers to lenders like Marcy and I, and there's other lenders out there that know this stuff, but when they come to us, we educate them and we help them understand how to put the deal together sooner than later.
We follow that argument you just made with, and if you made that purchase today, how much do you think that property is going to appreciate within that same
100%. So if you just take a very conservative interest rate, and I always ask my buyers, I ask them those questions because then I'm using their information. It's really easy. How much do you think your property is going to appreciate in the first year? Well, I don't know, 5%. Okay, well if you're buying $300,000, that means $15,000. And if you only needed the $10,500 at the $300,000 purchase price to save, you made up that entire amount in the first year in appreciation that's non-taxable. Oh, shit. Really? Yeah, no kidding.
That doesn't take into account buying power too. They're probably going to get raises over that 10 years. And,
Yep. All of those things, when you're educated as a realtor and you can communicate, when you combine yourselves with a strong lending team, you will kick ass. You have to be able. We have a new lender, our new realtor that came to work with one of our seasoned realtors, and she says, Todd, they won't lower the price on the house. They won't lower the price on the house. They're not going to sell, and I don't think it's going to sell for the price they want it for. And I go, let me talk to them. So we figured out what their net cash flow is going to be, and they figured they wanted to do the same thing. I need to net at least this much to make my house payment to be as low as possible. But in their situation, they had $40,000 in consumer debt with car payments and everything else that they weren't taking into account. So they were going to net $120,000. I go, well, we're going to take out of that 120 the $40,000 of it, leaving you 80, and you're going to get rid of all this debt, which is going to improve your cash flow $1,250 a month. Mm-hmm. And even if you sold your house for $30,000 less, you're still going to net 50. We can still put you into the USDA. This happens to be a property they're buying in La Pine. You're going to walk away with $50,000, and you're still going to be saving $1,250 because of all your other consumer debt. They just weren't thinking about it this way, but it also is because it was a new realtor that didn't understand that the economics associated, and she's young as well. So she was thrilled that they came to her and said, drop the price after the conversation with us. Drop the price in the house. Let's get rid of that thing. And they're downsizing. They're older. Their kids are grown up. And they just really want to move and downsize anyway and take advantage of the USDA. What was your question?
Isn't there a way to look at the total home price and decide and to figure out, for every increments of $1,000, what your monthly payment will be as well, not just down payment?
Well, sure. I mean, it's all interest rate based.
Yeah.
So
for the 4%, could you tell us what that would be too?
For a payment?
For your monthly payment, for your monthly mortgage
For
payment,
$1,000
every
more.
$1,000 and the sales price.
Well, you just answered it. If every 1,000 saves you $4.77, what does every 1,000 cost you?
Gotcha.
$4.77.
Okay, gotcha.
So 100,000.
It's the same thing then. Okay.
Exactly.
Okay, I didn't think of it that way.
Yeah. So a
okay,
$100,000 mortgage is 477. The easiest number to use is 5, right?
Mm-hmm.
So think about this. Here's an easy example. Mr. Buyer, Mrs. Buyer. If you took $10,000 and you stuck it under your pillow, but your monthly payment was going to go up $5 a month, how long could you draw the $5 a month from underneath from your pillow to make that monthly payment? You know what 200 months, right? Isn't that what it is? $5 a month, 200 months on 10,000. So 200 months is 16.67 years. So that's your break-even point by the time you got rid of, before you even look at investment, reinvestment potential, and property appreciation and those things. The economics right now, with rates being so low, it really makes no sense for people to save money for a down payment. It's usually better for them to get rid of their consumer debt, lower their debt-to-income ratios, qualifying for a higher payment, giving them the ability to now take Schedule A deductibility on their tax returns versus nothing. Okay, here's another question. I'll give you one, since we're doing trivia a little right now. If, this is going to be a little harder. We have somebody at Intel, and they're making $100,000 a year. Let's just say that. And they're saying, no, I'm just not looking right now. Prices are high, and I'm fine paying my rent. Well, how much is your rent? And they say their rent is $1,500. What's their real rent? Guy's an Intel employee, makes $100,000 a year, and he's renting for $1,500. What's his real rent? Raise your hand if you know.
So your question is, because I think your
How much-
what he's getting towards
Go ahead.
is how much money do they have to make?
$1,650. It's his rent plus the 10% lost opportunity he would have by the appreciation of having that money tied up in a property.
Well, you're thinking of it on a more complex way, but I like the way you're thinking. So let me ask you this. He's a W-2 wage earner at Intel, right? What does he have to gross
There you go.
Oh.
in order to net
That's
$1,500?
tax.
There you go.
What's he have to gross? He's making $100,000 a year.
See that 25% tax, 30, 50.
Federal and state. So, if he's 50% tax, what does he have to gross?
$3,000.
So how much is his rent really costing him?
$3,000.
$36,000 a year. And the minute you can talk to your buyers and put it in perspective for them, it empowers you. And they'll go, oh shit, I never even thought about it like that. You'll get people at Intel that make $100,000 a year and all they have is a W-2 wage, and they don't even have a CPA because they don't have itemized deductions. And they just deal with it. They're okay paying it. They're making $100,000, but they're netting their 50% each month, and they live with it. Well, wouldn't it be great if you could buy a house and qualify for X and then also reduce your overall taxable income? What are the 3 things that are deductible on owning a primary residence?
Interest?
Interest,
Okay, what else?
taxes,
Property taxes, and what else?
Insurance.
depreciation.
Only on investment property,
Right.
and so we'll talk about that, but on a primary residence.
And repairs, but no, that's where you sell.
If you work out of your home,
That's self-employed Schedule C, that would be somebody like you that would have it, but no, just for a primary residence. We'll take an FHA example. What's a payment consist of on an FHA loan?
point sell?
No. Well, so,
Principal, interest, taxes,
that-
and insurance.
and,
Mortgage insurance.
there you go.
That's what
So-
I said.
You said it?
I said it.
Oh, you didn't hear him, he's mumbling over there.
I was like, what?
Tyler had
Tyler
a-
gets a card.
Okay, Tyler, here you go.
I don't need the car.
You don't want it?
I'll take it.
Yeah. Yeah. We did this at the Amber Glen office,
I'm
and
getting
Courtney
paid here.
is jumping over the table. She's like crawling over. Like, I said it. I said. I'm like, you've already got 3 cards. Jesus.
I didn't think of it because I haven't paid mortgage insurance, so.
Well, and you won't, and there's a formula for it. But you were also right in closing costs. So, in your first year's acquisition, if you've got people buying right now, one of the advantages is, look, you're going to take all the advantages on an FHA buyer, USDA, or it could be conforming as well, but all their closing costs are going to be a deduction. They're going to prepay their property taxes. That's going to be a deduction. The interim interest figure and the interest they're going to pay throughout the rest of the year isn't going to be that big of a deduction, but they're going to have those advantages to reduce their overall taxable income on a Schedule A by having those things. And sometimes it's not just being able to talk about it, it's being able to show them. You know, if your gross income is this, here's your interest you're going to pay through the year, so that's going to reduce your overall gross income. Here's your property taxes, it's going to reduce it even further. And in the given year, your closing costs, and if you have mortgage insurance, that as well, but there is a formula that goes with the mortgage insurance premium for deductibility.
So Todd, if you have a buyer that's
Don't try to trick me, Marcia.
that's concerned that their payment's gonna be $50 higher than what they had budgeted, but they're gonna own a home, what's one thing that they can do to help offset that?
So, what Marcia is bringing up is the other aspect of most employed people file a W-4 with their employer and they claim exemptions. Most you'll find are filing a W-4 single and zero, or if they're married and two. And so we often coach our buyers of adjusting their W-4 exemptions to 10, 8, 7. We can go through a calculation to figure it out, and the CPAs, we usually bounce it off of a CPA. So raising the exemptions nets a buyer more income each month. Because of the offsetting tax deductibility, they're not going to have a tax liability at the end of the year. So that's a little trick that we use often for helping get people off the fence, because they're not thinking, they're going, I'm only going to net this much. No, you're not, because we're going to adjust your W-4s and you're going to have more money coming in each month. Does that make sense?
It's these first-time buyers that they're just stuck. They have a mindset. You know, they really think, I can't do it. I don't know how to do it.
Get them to us and they'll know how to do it.
Yeah, and they all have the same answers. I don't think I have enough money. I can't make the monthly payment. It's all the same responses.
We used to do classes often with first-time home buyers years ago, and then our industry changed and anybody could get a loan if you just had a heartbeat. And then obviously what happened there, and that changed. And it's gone back to being very vanilla. We're Baskin Robbins now in our industry with only one flavor. It's vanilla. There's not a lot of sprinkles or anything with loan programs. They're coming out. They're becoming more available, but they're not as much.
So it's the service side that you separate everything, your differentiator.
I think the knowledge side.
Yeah.
So knowledge being part of our service is we're extremely versed in the financial side and helping people understand and handling that objection and knowing how to ask them questions in such a way that they figure it out themselves. A lot of the millennials, no offense to Tyler here, they're kind of set, and they think they know, and they don't know shit.
I know lots of things.
No, I'm not saying you. I'm just saying no offense to Tyler.
None of them very relevant.
But
Well, and the other thing
What
was,
they don't know what they don't know.
Exactly.
That's what it really is. They don't know what they don't know.
that's right.
the other thing with first-time home buyers is it's really advantageous to get them in the office so that they can see it on paper.
Yeah.
Because it's one thing to spurt all this information at them and they're just like walking away going,
I have this guy that I've been trying to send to you for months, and he works at Boeing, makes like $150,000 a year, and he was refusing to even meet.
I know. So
'Cause
let
he's
me
stuck
or
in-
Marcia call him and go, look, come in.
Yeah.
I'll grab some beers and let's just have a conversation. Let's talk about real numbers.
The worst thing that happens, he gets free beer.
That's right.
No, he don't even like meet right now. He's just like stuck in his own ways. It's just. I can't believe it. He's just throwing so much money into house payments.
Say,
for
if there
rent.
was a chance,
it's crazy.
ask him this. Say, if I told you I wanted you to go to this location and there was a possibility, very likely, but a high possibility, that there was going to be a bucket with $10,000 in it, would you drive to that location?
I'm just going to give you his number at this point.
And sometimes, again, because I tend to be more analytical, and I'm still trying to be personable and deal with different temperaments, talents, and convictions. Marcia tends to be very much of a hand holder and sweet and nice, and so
me.
if it's she'll jump in when we're talking to people, if they're not kind of getting what we're talking about and asking the questions. And
Sometimes
sometimes,
to my son too.
just send your son to Marcia, because she'll just,
I'll handhold him.
she'll
We'll get
handhold him
there.
and coddle him and talk about it.
They got real mindsets, and I talk until I'm blue in the face, but I'm mom. So.
Well, she's a
Yeah,
mom.
they won't listen to it.
So the VA loan, by far, this is the best loan you can ever have. And there's no question that being a veteran, and serving our country, they have some great benefits. And a lot of veterans are very, very confused about their benefits. Let me ask you this. How many times can a veteran use their VA eligibility to buy a home?
As many times as they want.
Yep.
Okay. If you ask a veteran that, they won't know. In general, they'll say once.
One time thing.
Marcia and I have met many, many veterans that said, I've been kind of saving it. Shit, dude, you're 70. How long are you going to save it for? Okay? I mean, how many homes are you going to buy here from here on out? It's like, God.
The other thing is lots of times they don't know that they do qualify, and so in order to know if a client qualifies, they have to get their VA certificate of eligibility, and that's something that we can order online for them, and probably 75% of the time it comes back instantaneously, and if it doesn't, then it's usually about a 2 to 3 day turn time. So we just ask them a few questions, fill it out online, and we'll get their certificate of eligibility right then and there.
And Marcia is an expert on the operational side of the mortgage business as far as how to find information out, how to quickly obtain VOEs, things when there's a struggle. Marcia being in the business now 31 plus years, she gets that side very, very well and is very helpful to do so. But the VA loan with no mortgage insurance, 100% financing, low interest rate, the ability to qualify and use it over and over again is a great, great loan program. And we push it all the time. So target veterans. They're a great resource for you guys, and we should target them more as well, and we don't. And there's a credit score, it says 620, but there are exceptions. I mean, really, it technically would go to a 580. It comes back to making sense. When we go in to get a loan insured, I don't know of a case where we have not obtained a veteran to get the loan insured. Just like when we do FHA loans, they get insured by FHA. Who do you think provides the financing for a VA loan?
Fannie Mae,
Federal
Freddie
government.
Mac, or one of those? No?
The banks, the lenders.
There you go. You got a card. So, yeah, we do the financing. FHA loans, we're the lender. We provide the financing. And other lenders provide the financing, unless they're a broker. But if they're a lender, they're providing the
Guarantee.
financing. All FHA does is provide the guarantee, and they insure it to X percent. A VA loan insures it to X percent. That's all they're doing is insuring the loan, but they're definitely not providing the financing at all.
On VA loans, the one thing to watch out for is in order to use VA benefit, you have to be military personnel, and you have to be married to use a co-borrower's income. So if you have mom and son, and the son's a veteran, you cannot use mom's income to qualify.
We just had a
If you have
couple.
boyfriend, girlfriend, doesn't work. They have to be married to use both.
Married old
both
Go get
incomes.
married.
Tyler
Yeah.
Tyler's had a buyer who just got an older couple. They were in their 70s, weren't they in their late 60s?
Late
Yeah.
60s.
Late 60s, early 70s, and they went and got married and to qualify for VA financing.
Yep.
So I had
They
an
got married in a
issue.
week.
I had a
I'm
client,
not kidding.
she went to Lake Oswego Mortgage, they gave her a letter of eligible for VA. Her husband he passed
They were pretty
away.
much married.
She changed her name, her last name. So during this process of 5 months, finally found a house that they got accepted an offer on. Went to the title company, signed the papers, and Lake Oswego Mortgage came back and says, you know what, you screwed up, you're not eligible.
She should be eligible as a surviving spouse.
She's had a different name.
Did she get remarried?
And it's her husband that was in the.
She's a surviving spouse though, of a
Yeah,
deceased
she's
military.
70 years
She
old.
changed her name because she got married again, or changed her name because
I think,
if she got remarried? That would definitely negate it.
I don't think so, because what was the situation? They did a short sale too, and he was totally in charge of all the paperwork, everything.
Well,
She had.
that could, the
and
short
he did not
sale,
have no proof of anything.
But that certificate of eligibility would have stated whether he had eligible benefits or not.
But they were just saying they screwed up. That person that did that should never have given that letter out.
you said they got all the way to title to close and they didn't
the
close?
Certificate of
Correct.
eligibility that they ordered up front would have had a little clause on the bottom that he was not eligible for VA financing. So that was overlooked at the point that they received that certificate of eligibility. They didn't read it.
Okay, here's a trivia question with VA. Which veterans don't have to pay the VA funding fee and why?
Disabled.
And they receive?
Oh, yeah.
So if they were, have any kind of VA disability, any kind of partial VA disability, whether it's PTSD, whether they lost a limb, I mean, it could be a number of different things. But veterans that have any kind of that benefit that they receive monthly are exempt from the VA funding fee. Again, the VA funding fee is financed in. It just makes it a total loan. It just saves them, up to 3.33% in the VA funding fee. So for every $100,000, if they're at that level, $3,333 would be added to the loan amount. But that could be exempt.
She gets a card.
Yep, you get. So, on the conventional financing, the max loan amount on conventional is $424,100. It used to be $417,000 last year, and it went up a little bit. These are, they're anywhere. Typical are 5 to 20% down, or you can put more down. There is a 97% loan, meaning you can put 3% down. The 3% down, you better have super high credit and fall within the guidelines. Otherwise, the mortgage insurance premium is relatively high, and it would be better for them to go FHA versus the conventional loan. What else do we want to say about it? It's Fannie Mae and Freddie Mac. The two governing bodies on Fannie Mae, we use what are called DU, desktop underwriting. That's our automated underwriting system. Everybody uses it. Freddie Mac is LP, and it's not Loan Prospect. It's
Loan Product Advisor.
oh, there it says LP. Now it's LPA. I was looking on Marcia's screen yesterday, and I go, "What's LPA?" Thinking lender paid something. She goes, "No, Loan Product Advisor." I go, "They changed the name on the AUS system, so maybe they did." Anyway, on those automated systems, you'll run them. Now, if you've been in the business a long time and you understand some of the automated systems, you can do some things that are a little tricky. For example, your son that's self-employed, you might have somebody that's been self-employed for 2 years, and the first year they showed a loss, but the second year they showed a bunch of money. Typically, you need to average 2 years of tax returns. But if you run it and they have great credit and they have assets, you run it on LP or Freddie Mac, you might come up with a automated underwriting system that says, an approval that would say, we only need your most recent year's tax returns. So you can throw out the one they lost the money on and only qualify them on the second year's tax returns.
But that takes some thought, and as you know, when you're dealing with an experienced loan officer, they're going to look at that. They're going to see that in 2016 they made $5,000 a month on their business, and 2015 and 16 they made only $3,000 by average. So if you run it on the 5 and get the 1 year finding, you're good. If you run it on the 3 and get 1 year finding, well, then you're going to know to bump it up to the 5. So you've got to really be analytical and make sure that you're looking at best case to give the borrower the best amount that they can qualify for.
Any questions on conventional? Sometimes we do some things that are a little creative and we'll use a second mortgage. And we do these very, very often with people's primary residence. Having the ability to educate a consumer who's getting ready to buy maybe an investment property or a second home. They're getting ready, they're an Intel employee, they're going to go and buy a home in Sun River. They're getting ready to cash in stock. What all of a sudden happens if they do that? Capital gains, huge tax. So they're going to put $100,000 down. Well, then how much are you going to have to cash in to net your 100 to put down? right? I mean, you're making good money on your investment account. Do you really want to take it from there? Well, where else am I going to take it from? Sometimes it's as easy as putting a second mortgage home equity line of credit on their existing primary. Because what are they doing? All they're doing is repositioning their asset, right? They have a couple $100,000 in equity. They're just repositioning that equity and putting it as a down payment on the equity position of a second home. And not only do they do that, it's tax-free. They get Schedule A tax deductibility, and they're creating virtually 100% financing. So that's a little trick we use seconds for all the time in helping people understand how to use their equity position in their current primary in order to purchase maybe a second home or investment. The other thing that we do with second mortgages is we may use them to piggyback on a jumbo. So the cool part is, what's the typical down payment with a jumbo loan? What do you think the minimum typical is?
1,600.
No, I mean as far as percent
20%?
Yeah.
for a jumbo loan. Yeah, 20. That's usual. You can do 10%, and we honestly can do 5% down jumbo loans, only up to a loan amount of $625,000. It's a higher interest rate, higher MI. There's some things that maybe aren't as beneficial. There's 10% down products that we have and other people have as well that eliminate mortgage insurance. But one of the things that's neat about using second mortgage loans is you can put as little as 10% down, piggyback the loan to a conventional interest rate. So you have a first mortgage conventional at 424.1, and then you piggyback the rest with a second mortgage up to the 90% CLTV or combined loan to value. And I think there's another slide here that talks about that. And maybe not. So if you think about somebody that says, well, God, I really want that $700,000 house, but I just don't have $140,000 to put down. I don't have the 20%. Well, do you have 10%? Well, sure. I've got 70,000. So at 700,000, if we just did 90% of that and subtracted out the 424.1 for the first, they'd have a first mortgage of $424,100, and they'd have a second mortgage of $205,900, and that combined would be a 90% CLTV or combined loan to value, but they got into the jumbo loan with as little as 10% down and eliminated mortgage insurance. So you can do some things really creatively if you understand how to manipulate the numbers.
That's what we did. When we first bought 8 years ago, we got a really screaming deal on this property, and it was more than jumbo. So we maxed out the jumbo at 3 something, and then got another HELOC to make up the difference, and we paid that off like in 4 years.
Well, there are jumbo rates right now are really good. Our jumbo rate programs are very low interest rates, and so sometimes Marcia and I do find that when we're running the numbers versus doing a piggyback loan, we'll run the numbers to just do a straight jumbo purchase because it will give them an added benefit. I mean, we were running jumbos the other day for people on a 5/1 jumbo ARM, fixed for 5 years, and it goes to an adjustable, and it was 3.375. So with only 20% down. So super low interest rate, especially with people that maybe are coming into money. They're going to retire in 5 years. They just want to get into the house now, have the tax deductibility, and then they're going to have a lump sum that they're going to maybe cash it out if they wanted to, but they have some choices. So
We just wanted to avoid the interest, the insurance.
well, and again, you can 10% down gets rid of the mortgage insurance for sure, if you piggyback it. And there are jumbo loans with 10% down that eliminate the mortgage insurance as well. How do they do that? You want to get another card to answer that question?
How do they do what?
How does the jumbo programs work if it's 10% down without piggybacking the loan? It's just a straight 10%, and there's no mortgage insurance paid monthly.
I have no
Pay a
idea.
point on interest?
Hmm?
Pay a point on interest?
Oh, yeah, you could buy your interest down.
Is it
You wouldn't buy the interest down because that would just lower your payment. It wouldn't get rid of mortgage
No,
insurance.
it wouldn't.
No, you bump it up a percentage, not a full point probably, but some percentage to a higher rate to again increase that yield that you were talking about to
Okay.
cover that cost.
I'll give it to you. So there are programs out that automatically come out with a higher interest rate because they built in the idea that they're going to eliminate the mortgage insurance. They're just going to self-insure or they're going to do a lender-paid mortgage insurance, an LPMI. There's things like that that come into play, and they're not talked about. It's just they market it as a 10% down with no MI. And it's more of just a hot button because consumers go, I don't want MI, it's terrible. But MI is not terrible. If you can get into a house, take advantage of the appreciation, your home's going to continue to grow and have the tax deductibility. The idea that young kids today go, they've heard from their parents or their grandparents, don't have an MI, makes no sense. You know, if you're having a 10% appreciation rate, and it's going to take you 3 years to save the 20% to eliminate the MI, or if you haven't talked to a guy like us to put 10% down and piggyback it, you're losing out on all the tax benefits and the appreciation and the gain. So, construction programs. So there are, you asked about the 203K. We have a couple of FHA programs that are pretty cool. The FHA 203K is pretty common. It allows you to finance in the cost of repairs into the acquisition price of the home. So if the home's $200,000 and it needs $30,000 in repairs to make it lendable, the acquisition price becomes $230,000, with essentially $30,000 are going to sit, I'm making numbers easy, in an escrow account that are going to be utilized to do those repairs. Interest rates are a little higher, fee structure is a little higher, timelines for closing are a little longer because the consumer or the buyer has to go out and they're responsible to get the bids and contractors and cost plans, specs, cost breakdown, that kind of thing. We help them and we walk them through it and we help guide them to appropriate contractors.
Is this only on owner occupied?
Owner occupied only, FHA 203K.
Does each company offer this?
No, lenders?
Yeah,
Lenders really hate the program.
yeah.
We're one of them, we hate it. And most lenders that say they do it just like we do, but nobody likes doing them. And the reason we don't like doing them is because the consumer usually is they have to have their hand held, and you really got to be very involved. It's good if you have a realtor that really understands it, and we can come together as a group and help walk them through the process. You almost need to say, look, let's use these couple contractors, here's what we're trying to do, and help get the process going and not put the onus of responsibility on the consumer. It won't happen. They're going to be floundering. So we take advantage of our contractors that we know and help guide the process.
And I think a lot of it is they really don't know what needs to be improved on, and so you're chasing dollars. So at first they think, oh, we just want a new roof and we want this, new carpet or whatever. Anyway, and then they get into it and there's more to it, and that's where the HUD inspector will come in and give them a list of items that are needed, but the numbers constantly change, and so it ends up, I would say 5 out of 10 times that they price themselves out of it because there's too much improvement that needs to be done.
Yeah.
So the simpler, the better, the easier it's going to go for everybody else. If it's a total fixer,
And in some
most time
cases,
doesn't work out.
in some cases, properties are financeable. We just had a guy that he's looking to do a rehab program, and the home that he's looking at is, like Marcia is saying, it's not remotely going to be cost beneficial for him to get involved. It's a tear down, and he doesn't think so. But so be it. Sometimes a home just needs sweat equity. It is lendable in the condition it's in. Maybe it needs some new paint, needs new carpets, new countertops. You certainly don't have to stick a square peg in a round hole and say, let's get a construction rehab program. They'd be better off to minimize their out-of-pocket to get in, take their available cash, and use that to do the repairs and just do it over time and have a much lower interest rate and an ease of getting into the house versus the discomfort it's going to be putting him through the process of a 203K.
You can only use this on your primary residence, is that correct?
Correct.
And how long do you have to live there to use this? Does it matter? It's just primary residence?
There's no such thing as really the mortgage police that come around, but you do sign a document that says you're going to occupy the property, and typically it's a year. But if we have a client that just bought an FHA loan 6 months ago, and the house next door was zoned mixed use, and they moved in a business, and he wants to move. He's like, I don't want to live here anymore. They got a business out of this place, and it's not my bag. So he's going to write a letter of explanation and move, and it's not going to be a big deal. He is going to have to move to a conventional financing and make that a rental property for now, but But there are times you can.
There's people times you'll come across. I mean, I've had a couple people that are, they're only approved for, or they just only want to buy in the 200,000 range, but they don't want to live out in west of Hillsborough, so they want to live on the east side of Portland. And a lot of the homes are just not in good shape. A lot of times they're bank owned and everything like that. So, I'll tell them that this property's probably not financeable, and then that's why times a lot of buyers will look at this program right here, even though a lot of lenders dislike them.
So one of the keys to know whether a property is financeable is we basically look at health, hazard, or safety issues. So if it's
That's
not a
huge, yeah.
functioning home on its own, somebody can't move in and live there, it's not gonna be financeable.
So I bought a 203. I bought a bank-owned home, did a 203K on it. So I had 3 months to get this house ready. I got the house ready in 2 months. I moved in on the second month because during that 3 months, you don't make no monthly payment. So, my mistake was I moved in the second month. They told the bank, hey, he's living there now. So from that third month, I had to pay that mortgage payment. And I just complained, hey, I'm still not done. I still got my landscaping to do. So finally, I had to submit all my landscaping bills, and they did waive that third month. So you just can't move in there. Just let your clients
You can't move
know
in during
that
the repairs.
You can't move in. You cannot live in that
It
house.
has to be all finished and signed off.
And then they come in and they
Because you're not
reappraise it,
making no
right?
payments
Yeah.
on it.
Well, we would go by the when a certificate of occupancy is issued. So if there was, depending on your repairs, were your repairs cosmetic or structural?
Oh, I had siding, I had water in the
Yeah,
crawl
that
space,
doesn't
so I
make
had to
sense.
do all that stuff.
So you would have had to have had a county sign off on it before you were able to move in technically, according to the lender. What you do is to your own accord, but we wouldn't have forced that because you technically shouldn't be living there.
Right.
There's a lot of innuendos with each 203K, so it's a case by case. It's a program that's available. We do it. We actually have an entire 203K department at corporate that helps, coordinate and do all these things. It's available. It would not be a favorable product for anybody unless you have a team that you can help guide the whole process and have contractors that you work with and get everybody on the same sheet of music. Right now, contractors are so busy, it's hard to pin them down unless you have a great relationship with them and they'll fit you in.
But I love this loan, love it, because I just added $30,000 to my mortgage, and that didn't cost me $1 out of pocket.
Yeah, and the advantage is
Costs you
that
$150 a
there's
month.
an appraisal done on the property as is, and also based on future value.
The
So
increased payment.
once you give all your plans and specs and whatnot, the appraiser will say, okay, when your house is done, it's gonna be worth 300, right now it's 250. And that a lot of time will make or break a deal.
If you
And it
added
has to be-
30,000 repairs, that's financed in. In $5 per thousand, we were just talking about that. So it's a $150 increase, but Dave didn't have to have any money out of his pocket to do the repairs. And then he already had a built-in equity after that.
Because my buyer says, oh, I can buy something and fix it up myself.
That's fine, but they're not gonna do it on a 203K without a licensed contractor,
Okay.
right? They have to have a
Right,
license.
have to have a licensed contractor.
Yeah. And they could do that. I mean, they could know somebody and
But
they could end up doing the work.
He's like a first-time home buyer. I'm just like thinking this process might be a little.
Oh, for sure. He needs to have him talk to us and we'll talk him way out of that.
So,
Please
Marcy,
do.
does safety, health, and hazard still does that still matter with this loan?
No,
doesn't-
because it's a rehab loan to get it out of health hazard and safety.
Okay, gotcha.
issues.
But it just needs to be within safety, health, hazard after the repairs are done.
Right,
Yeah.
Okay.
right.
Yeah.
We have a cool
Because remember
product.
Jake Steele, then he didn't go to Vancouver.
Yeah, exactly. We have a cool product. It's called an OTC or a one-time close FHA, meaning they qualify once, they get the money, and they can build a house. So the acquisition of a lot, the construction of a home, and one-time close. We're getting ready to do one right now, a couple of them, and they are. It only requires 3.5% down. It is FHA. It follows FHA guidelines. It's about 1% above the market rate, kind of similar to the Chinoa, but it doesn't. You do have to have the down payment. But it is a great all-in-one construction program that not a lot of people have and offer.
It doesn't convert to a conventional.
It's fixed. An FHA, it stays as an FHA.
Are they both out on the market now? Can you get a construction loan and then
convert it to something else after you go through the,
You could do the FHA construction loan to get it built, and then once it's built, you could refinance into a conventional loan. You'd be paying a second set of closing costs, but you could do it.
But what we tell people is just carry it for 6 months after it's, it's been, the completion notice is posted, or how long you've had the home in your name. And if you've had it, maybe construction only took 3 months, 3 months later, look at the appraised value, because at 6 months we can look at appraised value. Refi out conventionally, because you're gonna have an equity. I have a builder that is getting ready to do this, but he's gonna have to hire one of his builder buddies to be the builder, and he's gonna be the buyer. So he's really gonna do it, and he's gonna have a tremendous amount of equity already in the home, and he just wants to come in with minimal out of pocket. So 6 months down the road, he'll refinance and do a conventional loan and have a 80% or less LTV and no MI.
3.5% down, right?
Uh-huh.
A builder's gonna be using the FHA 203K.
He's building a house for himself.
You're-
but he
I was
can't-
gonna say,
You're-
like, why would
he
he?
can't
for
be an
himself.
owner builder, so
Your
he's having
cousin's
to use a
buddy.
friend.
Oh yeah.
Booth, Bryant.
He's not
Booth.
using that as his primary residence.
What?
He's not
Yes,
using
he is.
Yes, he is.
the one in Canby.
No, that's another one that he's building that's a spec.
Oh yeah.
This is one he wants to do for himself.
Oh, I didn't know about that one.
Yeah.
Oh, I'm gonna be someone. It's like I should probably know
You
this.
can do an all-in-one construction loan through FHA 203K.
No, through FHA, not 203K.
It's like, I got confused there.
It's just FHA. 203 is a separate rehab loan.
Right, right.
This is just an all-in-one construction loan.
So do you pay the full amortized payment during the construction process, or is it interest only up until you occupy?
It's a full amortized payment, but there's an interest reserve that's going to cover it. So there's calculations that go into play during the construction phase. So they're not going to be homeless and have to make a payment and have to pay rent.
That's what I'm thinking.
So there's
yeah,
no double
yeah.
payment.
Yeah, there's not a double payment. There's an interest reserve that's created in the process.
Okay.
Yep. Now the takeout financing or for construction, we have access to construction loans that will do the construction, but then you need to put permanent financing on. So it's really a two-step construction loan, and we don't do them that often, but we do them.
Years ago, I built a house and we used all of one construction loan, but I remember that we only paid the interest.
Uh-huh.
That's it.
That's right, during the construction phase.
Yeah.
Yep, and that's why I said we have an interest reserve that will cover that monthly payment for the time frame until they move in, and then it'll be a
Because
full.
FHA doesn't want the
Yeah,
borrower
pay
paying
nothing
rent
until-
and then
until-
paying the construction
Well, we
payment
did
on top
both.
of it.
We paid
Yeah.
on our other house, which was it was still to be sold. It was
Right.
waiting.
And then you had interest
And I
payments
had
monthly
interest.
on.
We did both.
Right.
You could have in that program. You
So
won't on this one.
usually, there was an option back then, if you had 20% down, you could either set up an interest reserve to have it cover the construction interest and only have your primary housing expense, or no interest reserve and you're responsible for making both.
Okay. I don't know why we chose that way. Maybe it was cheaper at the time.
And it could have been the lender's specifically the lender
Yeah.
that you use.
Tell you got about 10 minutes.
Okay, we'll fly. Well, I haven't seen Kim pull up yet, so we'll tell her to hold on.
She said she'll be here at 10:30.
We'll tell her she can be here at 10:45. What time is it? Text her back and say, be here at 10:45, and then we'll go through another. We'll
I'm
go
not
through.
gonna, you can text her that.
What? She won't answer my text. We talked a little bit about lenders throughout the process: the mortgage banker, the mortgage broker, the direct seller servicer. So, a mortgage banker, they originate the loan and typically closes in their name. They will usually sell the servicing to a servicing company, and they'll receive what's called a service release premium from the investor when they do that. And they typically will have to deal with what are called investor overlays. So an example would be a correspondent mortgage lender locally. Let's pick one that somebody would know, like Mortgage Trust. They would be a correspondent mortgage banker. Nothing wrong with Mortgage Trust, and they would then sell the loan off to potentially Chase or Flagstar Bank or U.S. Bank or Wells Fargo, some actual servicer for the loan, and they would end up getting a premium. The banking side of their operation does to do this, but they have to adhere to any of those overlays. So you avoid the overlays of when you can deal with Fannie Mae and Freddie Mac direct, and that's when you're a direct seller servicer. That means you not only originate the loan, but you also service the loan.
So an overlay would be if Fannie and Freddie Mac state that we don't have to document any large deposits that go into a client's bank account as long as that large deposit doesn't exceed 50% of their gross income. So if somebody makes $5,000 a month and they've got a couple of, $1,500 deposits, we don't question it. But an overlay might be that that specific lender says, okay, Fannie says 50%, we're doing 10%. So they're just gonna be a little bit more stricter than what Fannie and Freddie is and create more documentation needs.
Or they might say, hey, I don't care if Freddie Mac said we don't need 2 years worth of tax returns. We're going to require you to have 2 years of tax returns. So there's times when you deal with correspondent mortgage lenders and not a direct seller servicer that a buyer can get into a situation where it might be a little more precarious for them to qualify for a program a little more streamlined and easier. If we're a seller servicer, so we service our own loans and have a servicing department and so on. The next one would be the FDIC, the Federal Deposit Insurance Corporations, which would be Chase, Wells Fargo, U.S. Bank, bigger institutions like that are federal banks. And I think everybody probably has had an experience, if you've been in the business a while, with those. Some are okay, and some make people's lives in the lending side a nightmare. We talked about one of the financial facts was every, I knew that slide was on here somewhere, but every $1,000 a person puts for down payment, it saves them approximately, in today's market, $4.77. Or if you borrowed $1,000, it would cost you $4.70. One of the critical things that we would tell you would be a huge benefit to you and your buyers is coach them up front. Don't have them changing jobs. Don't have them taking out new credit. Don't have them moving monies. We have to document paper trail cash flow. Where did your money come from? Well, my parents gave me this money and they put it in this account and I moved it from that account to this account. Nightmare. If we're doing gift funds, we always tell everybody up front, no money's transfer hands. We're going to have your family wire the funds directly to closing and simply do everything we can for our buyers and the realtors to simplify it. They're going to have to be prepared to provide documentation. Typical is going to be 2 years tax returns and W-2s. If they're self-employed, they're going to have corporate returns and K-1s. Most recent pay stubs. A lot of self-employed people won't have pay stubs, so they're going to give us year-to-date P&Ls. They're going to be non-audited. We're going to have already pulled credit, most lenders will, and if there's any derogatory credit they need to explain, we'll help them with that. We usually just go with it over the phone and we write the little letters of explanation they need and then PDF it to them for a quick signature. That's what Marcia was talking about, deposits being sourced and seasoned, where a general rule would be 50% of their monthly income. So if there's a lot of deposits, and then we'd want to know where those came from. And it's just preemptively letting the consumer, the buyer, know that they're going to be put through, it's a little taxing. And it's arduous at times, but if everybody's on the same sheet of the music out of the gate, then they're not having anything that will be, that they won't, they know it's coming. They know that that's what's going to be expected.
So one of the things that we come across as clients, sometimes clients have cash on hand, and cash on hand can be used if it makes sense. In other words, we will look at a client's bank statement, and if it shows that they got their paycheck deposited of $3,000 and then they took out a $1,500 withdrawal and they have minimum debit card expenses, it's likely that they would have cash on hand. If we look at their bank statement, they get a $3,000 deposit, they've got a check $1,000 going out to rent, and then all these debit card transactions or bill paying, and they've got nothing left over, the chances of them having cash on hand is probably not. So we always have to dig into that cash on hand. Sometimes we have to funnel it through a gift, like maybe they did have cash, we can't prove it, we can't use it. So then they give it to their parents, the parents gives it back to them, and we treat it as a gift.
Parents have to have documented funds available, but what she's saying is if parents have the ability to gift funds, let them gift it and then pay your parents back after post-closing and not make it a big deal. Moving money around creates a challenge. Just be very aware of that. And don't be afraid to tell your buyers, Don't move money, don't apply for credit, don't do it. Just stay clean, just do
And
your
just-
job
just
and go
tell us-
home.
Tell us the truth.
Don't buy a car.
Just tell us what you're doing and then we can help you.
Don't buy a car.
Yeah, we had a lady that was co-signing for her son that turned in her old car during the process and went out and released a new car at a higher price, and they were already having a debt-to-income ratio issue, and it pops up. So once we pull credit on anybody, we get a credit alert. So once they're in our system, in any banker's system, and we're doing a file for them, if they apply for credit, there's an immediate alert that pops up on our email, and it says these people just applied for credit. So then we got to go to them. Did you open a new account? And if they haven't yet, we usually say, don't do it. Just wait, and we'll write a letter of explanation. They were going to do this, they decided not to, and they'll sign it. Do you want to talk about the derogatory credits aspects of the bankruptcy side, and or do you want to send that whole
Well,
sheet out?
I think that's pretty self-explanatory. There's the investor guidelines for whether they've done a Chapter 7 or 11 or 13 bankruptcy. Each conventional FHA, VA, USDA has their own rules on that.
And we can send out a sheet that's a summary that's really easy to use that tells you everything as far as if they qualify for a USDA or an FHA or a VA or conventional after a bankruptcy, when do they qualify, after a Chapter 13 or a 7, whether if they had a foreclosure or a short sale. And it's easier than kind of going through it on this.
Yeah, and the other thing is we will always pull, if it's a foreclosure or short sale, we want to get the property address because we'll pull the deed because it has to be based on the date the deed was recorded, the short sale deed was recorded. So sometimes they think, oh, I had a short sale in February, but the deed didn't get recorded till May, so we have to go off the May deed date. So it's always important to get that property address and then we can figure out exactly what their timeline is.
And even though on a bankruptcy on an FHA loan is 2 years from the point of discharge, if it included a property that was in foreclosure, in most cases, the bankruptcy supersedes the foreclosure, meaning it was going through foreclosure, screw it, we're filing bankruptcy wiped this out, but the trustee ended up with the property, but they didn't get the property sold, and if it sold short till later after the discharge date, that date on an FHA loan would then really circumvent, and that's the date that dictates whether or not they're going to qualify for FHA financing. It's not necessarily 2 years from the date of discharge on the bankruptcy. And that's a caveat people get caught up in. And even Marcy and I have gotten caught on that on a couple times and had to switch gears and move into a non-qualified mortgage to qualified people versus waiting the timeline out for its sale. And it's crazy. You'd think if somebody filed bankruptcy and they relinquished their property, who gives a shit if that bank took 1.5 years to resell it? It's their responsibility. But FHA doesn't look at it like that. Conventional does, but the problem with that is the conventional bankruptcy, you have to wait 4 years from the point of discharge. And that's why we were talking about MI. If somebody had a bankruptcy, it's way better for them to buy something 2 years earlier than to wait 2 years, especially in an appreciating market. And pay the MI, who cares? Pay it, take the tax deductibility, take advantage of the tax benefits, and then take advantage of the appreciation. I think you guys know about loan cycle. You know, I think the biggest thing that you can do is get your buyers to a lender for pre-approval ASAP and to provide the documentation and have good open line of communication with the lender as far as what they're telling the buyer he needs to provide and making sure that you're included. We include our realtors in all emails. Sometimes we talk about personal issues and we may not CC them, but we'll forward the email and say, you know, this is what's really going on. We'd like to keep our realtors, you know, in the loop as far as what we're asking the consumer for, and keep everybody on the same sheet of music. CDs are another thing you'll see on item 8. Those have created a nightmare for lots of people. People are waiting to issue CDs until they'll have a clear to close and a you know, commitment to lend, and the appraisals are in. So I'll ask this will be this, and Tyler, you can't answer. Is the CD, and you have to raise your hand to answer, is it a commitment to lend?
No.
Correct. So, a CD, all of us lenders, primary residential, PRMI included, we made adjustments 2 years ago when the rules came out and said you're going to have to disclose to the consumer because of TRID, and the costs associated with it. And we set these rules and guidelines and hard stops. We're just as guilty as lots of lenders out there. We're quickly now changing the rules associated with how fast you can get a CD out, because if we know the costs, there's no reason for us not to get a CD out. But waiting at times for an appraisal to come in, when appraisals are being slow at times, to get a CD out, to then have 3-day period, to then have to go to closing and potentially extend closing dates, we're trying to work around those and take away the hard stops, because it is not a commitment to lend. So here's another trivia question. So who knows what TRID stands for? Raise your hand. Tyler, do you know?
I do. Of course.
Okay. I'm not going to let you answer it.
Truth and lending discussion?
No?
TRID.
Google it.
No, I'm not, I'm writing it down. I'm in my notes.
Okay, well,
TRID.
Do you know what lenders call TRID? What the acronym is for lenders? The reason I drink.
Do you want me to write that down?
Yes. Write that down.
That's important.
So the TRID is TILA RESPA Integrated Disclosure.
Oh,
It's an acronym of acronyms.
Yeah, it's an acronym of a bunch of crap, and it's a big pain. The biggest pain has been working around when CDs go out. But in general, doing some of the things we need to do, it's not that big of a deal.
Especially truth in lending.
Well, the old truth in lending disclosure is now encompassed in our in our CD, right? I mean, so it's really, the old truth in lending showed the APR of the product. It's all kind of in one encompass. I really don't like that the closing disclosure does a summary for closing costs and prepaids, but on the closing disclosure, it calls it closing costs. So all of you need to be aware of when you get your buyer, he goes, Jesus, the closing costs are a fortune. Well, they didn't really read the print that it's not just the closing costs, it's also your property tax reserves, your homeowner's insurance, your earned interest, but they lump it into one line item called closing costs. So the other thing, when you have an FHA loan and you have an upfront mortgage insurance premium that is 1.75 of the loan of the loan amount, it adds another gigantic cost, but it's really financed in. So it inflates the aspect of what the CD looks like. So those are just good things to have when you're having a conversation. Don't panic when you see your CD. Those aren't your closing costs. They're the combination of closing costs and prepaids and your finance in MI if it's a
So it's the Truth in Lending Act and RESPA, the Real Estate Settlement Procedures Act.
TILA, RESPA, Integrated Disclosure.
Jesus.
Okay.
So it's like acronyms of acronyms.
I don't remember this being on the test. I remember them separate.
Yeah, I remember RESPA.
RESPA.
I remember RESPA, but I remember TILA, but they weren't together. No, I mean, not together, I meant
Integrated, yeah.
integrated.
Yeah.
I saw the Truth in Lending, yeah, it wasn't.
And you guys know what we need. You know, if a borrower is divorced, we need a full divorce decree, especially if they have child support payments and liabilities. There are times where we're going to have people have a judgment because they're back on child support. That has blown up a number of different transactions. If they're in a payment plan, it won't necessarily blow it up. But if there's a judgment against them that they're back on child support, that would have to be paid in order to have clear title. Bankruptcy paperwork, including including the discharge, we match those up with the credit reports just so everything makes sense. Self-employed, we talked about that, year-to-date P&L and so on. I really wanted to show these guys Avenue, because they probably haven't seen Avenue. Has anybody seen Avenue, our technology?
Briefly, yeah.
I don't know. We can do another class on that. Or we can
Yeah.
do a show in the Bethany office too.
You know, we have a technology called Avenue, and it's
Another acronym.
no, it's not. It's
No,
just,
it's not?
and it's AVENU, but it's a technology that takes into account 640 plus or minus data points on everybody. So it's like having a database on everybody as well as their behaviors. And so if you could think about going into an area and being able to geocache the area we're in here right now. Matter of fact, I haven't seen Kim walk in yet.
She's right there.
They're waiting.
They're waiting. I'll show you just a real quick example.
I'll blame it on you.
And but it's cool technology that it's pretty powerful.
Is there an app?
There is. You have to, if you're interested in getting it, you can call me, and I'll show it to you.
While he's getting set up there, what's one thing that you don't want to send to a lender? Does anyone know what that is? I screwed up, and it cost me a lot of money my first deal because of this. Does anyone know?
Don't want to send to your lender?
You don't want to send what document do you not want to send to your
Gotta
lender?
update it. I can't show you
I
guys.
don't know.
I gotta update it.
The inspection.
The inspection and the repair addendum, right?
Yeah.
Mm-hmm.
If you send us a copy of the inspection, me and Marcia, no harm, no foul. We are not going to submit that to underwriting. One of the things that Tyler's talking about is if you have repairs that need to be done on a home, you definitely do not want to include those on your purchase price addendums for what repairs are required. Or things like, you know what, we're not going to do the repairs, so you're going to give us $5,000 towards closing costs and prepaids. You would want to write on an addendum, seller to contribute $5,000 towards closing costs and prepaids, all other conditions to remain the same. You wouldn't want to write, seller to contribute $5,000 towards closing costs and prepaids in lieu of repairs. You don't want to write those kinds of
So
things.
you never want to mention the word repairs?
No.
On your,
You want to
Just
keep them
that
separate.
flat fact. That's all they want to see.
just
Yeah.
prepaid?
Just the numbers.
And another thing I did was
I learned
with
about
your
the hard way.
addendums, I did like 1, 2, 3, 4, 5.
Oh yeah.
And then like number 4 was repairs to be done. So then I had to change everything.
And then they're
because
asked why
the
what
lender was saying,
document
yeah,
this is.
where's 4 at?
Credit scoring.
That's why I never. That's why you never number your addendums. Just put like the date and maybe the first letter of their last name. So.
Yeah.
One of the
They're gonna be
things,
like, where's this addendum? You know.
one of the things that we didn't talk about was credit scoring, and you got Marcia's card. I shouldn't say we, I would say Marcia is very, very good at people that come in and have credit challenges and helping them to raise their credit score to a point where very quickly they would qualify for financing. Or in many cases, somebody has a 680 credit score and Marcia just runs quick credit analytics to get them over 700 because that could be the difference in a 0.25% in rate. And it can be as simple as we had a client that had a 667 credit score, and all she had to do was go open an account for 30 days and let it season for 30 days. So Capital One bank account. And we re-pulled during the course of her purchase, and her credit score went to a 717. So think about on a conventional loan, going from a 660 something to a 717 and what that does for an interest rate. So Marcia is a great resource for your clients that maybe have some credit challenges because it's a math, it's a algorithm and it's mathematical and it will spell out exactly what a consumer needs to do. Pay this amount down to this amount. It is exact. And she highlights it, makes it bold. And if they go do those things, bring us the receipts, we immediately go in and she does a credit rescore. And I can't tell you how many people we've taken from the 5s into the mid-6s and qualify them immediately for the 100% financing.
And 740 is the highest, right?
Credit scores will go up to 800.
I know, but 740.
740 is a great cutoff for the best pricing for conventional financing or really any financing.
I mean, 800 is not going to get
Anything better than a 740. No, and you'll get people like that. Most of the analyticals. Oh, I was sure I'm an 800. Well, you're 790.
Yeah.
I don't know. I'm like, it doesn't fit. It really doesn't matter. You know?
I think the biggest mistake people can do is they have collections and they think that if they pay that collection off, it's going to help increase their score, and it's the exact adverse, because what it does is it takes that collection that was reported in 2012 and it brings up a current report date, so it's a negative. So if the lender wants them to pay off the collection, which if their collections are greater than combined total of 2,000, they're probably going to have to pay it off. But we only want to have them pay it off at closing. You do not want them to pay it off during the course of the loan being processed. And another big, quick, easy fix for raising somebody's credit score is if they're an authorized user on an account, that's a negative. So lots of times I can take people from 580 to 640 just by removing themselves off of their husband or wife's account as an authorized user. So, and sometimes it's as easy as just paying an account down $50. Sometimes, but we do run the analytics and give them exact math of what they need to do.
Exact.
It's really cool, and it's my passion.
So I should send you my son.
Yeah, so anybody, even if you have kids and you want to see what their credit score are, it's a great thing to do because it will put them in a better position for auto loans, for buying a house, for everything, and we do it complimentary, there's no charge.
Who
It's
didn't get a gift card?
I didn't.
You're not getting one. You didn't go?
I didn't get one.
Sure.
There you go.
It's Christmas out
I
here.
didn't get one. Even though I talked a lot, that doesn't mean I just asked a lot of questions.
That's good.
Because I'm learning, so.
Well, thank you guys so much.
Yeah.
Thank
I've
you.
seriously had buyers that I've had, been working with their current lender, and their lender just couldn't get the job done, and they thought that there's no way this person's getting approved. And I sent them over to Total Mercy, and they somehow find a way to get them approved. So it really matters who you're using on your deals. So
It's just when you have, there's a lot of really good lenders out there, and there's a lot of people that are just new to the business or newer. Those of us who have been in the business a long time, we know who each other are, and if we hear the name, we're very supportive of one another, even though they work in different companies. But there is an advantage in any industry when you have a wealth of experience and knowledge as far as how to structure something. And sometimes you can't believe how easy it is to get somebody approved that aren't approved. And you almost feel bad taking the deal. And in some cases, we tell them, stay where you're at and do it like this. Because they're so far into the process, they're going to have to get an extension because we're going to have to go through disclosures and things. Sometimes it's just easier for us to make the deal happen for you guys and not make it a big deal. Just by coaching the other lender.